When you read the first few lines of Charles Dickens' novel, The Tale of Two Cities, which says it was the best of times, it was the worst of times, you suddenly start to think about Indonesia and Malaysia. We have seen very divergent market moves over the first half of 2026, and that's largely a result of the different directions in policymakers in both of these economies have taken. For Indonesia, it's been a flurry of negative headlines that have hit the wires since the start of the year. We've seen this from Moody's downgrading the sovereign rating outlook to negative from stable in January, followed by an MSCI review on whether Indonesia needs to be downgraded from a developing market to a frontier market. Fitch also followed suit with an outlook downgrade in March, and since then we've had policy announcements, particularly the announcement of Danantara Sumber Daya Indonesia, which looks to consolidate export receipts for commodity exports, causing a stir in the market. Perceived risks around policies are very high at this point, which are leaving investors hanging with more questions rather than answers. Against this backdrop, growth has been relatively stable at 5%, but the concern here for Indonesia is not growth. We have stated time and time again that the concern for Indonesia is always on the external front, and particularly the balance of payments as well as the fiscal balance. Indonesia is a twin deficit economy which sees deficits on both the current account balance as well as the fiscal balance, which means that there is a huge need for capital to finance both the current account deficit as well as the fiscal deficit. When there is a stir in terms of capital inflows, portfolio inflows as well as FDI inflows, it tends to shake up the balance in terms of these twin deficits. We do not believe that Indonesia's macroeconomic situation is anywhere close to past crises or past periods of stress that we have seen, particularly in 1997 or even the taper tantrum in 2013. That said, the authorities do have to be extremely mindful, and the onus right now is on the authorities to provide greater clarity and greater direction for investors that are looking to stay interested in Indonesia. In terms of the policy mix, the risks around the fiscal balance have reduced considering that global oil prices have come down. There is also news flow suggesting that there will be cutbacks to the free meal scheme, which is a flagship scheme under President Prabowo, which provides free nutrition to school-going children as well as expectant mothers. However, will this be enough to quell fiscal risks that we've seen build up since the start of the year? That remains to be seen. What we do believe, though, is that it is enough to keep the fiscal deficit below the 3% of GDP legal limit. Public debt to GDP in Indonesia remains very well contained at around 39.5% of GDP as of end 2025. Therefore, the concern is not so much on public debt as it is on keeping to fiscal deficit rules that have been followed for decades now. On the external front, we have seen extreme volatility come through in the last couple of months. This has led Bank Indonesia to raise its policy rate by a cumulative 100 basis points in 29 days between May and June. This includes a 25 basis point rate hike on the 9th of June at an unscheduled meeting. The question now is, how much further can BI take the policy rate? And we have penciled in significantly higher rate hikes from Bank Indonesia. So we are looking for the policy rate to end the year at 6.75%. Which means that BI will remain extremely vigilant on external pressures as well as risks around domestic policy, while acting proactively to maintain IDR but also overall macroeconomic stability. The question for the medium term is whether President Prabowo's administration is able to convince investors that all the action that has been taken in 2025 and 2026 ultimately feeds through into the desired results. Creation of Danantara, the creation of Danantara Sumber Daya included. As we look to 2027, we do expect a little bit more stability for the Indonesian economy. We do predict that GDP growth will remain at the 5% handle, with headline inflation within the central bank's target of 1.5 to 2.5%. As external pressures abate, we do believe that Bank Indonesia will have room to reduce these tightened monetary policy conditions. By contrast, Malaysia's story has been one of a positive glow. We've seen growth coming through and exceeding sometimes the official growth projections of around 4 to 5%. Growth in the first quarter of this year was extremely strong, and incoming data for the second quarter of this year suggests that GDP growth will remain around the 5% handle. GDP growth has been supported specifically by the electronics and electrical appliances sector. This sector has supported exports as well as production. With Malaysia highly plugged into the global supply chain for E&E, we expect that this sector will continue to bolster growth into the second half of 2026, but also 2027, albeit at a slower rate of growth compared to this year. The World Semiconductor Trade Organization has increased its growth forecast for semiconductor exports significantly to closer to 100% in 2026, which means that Malaysia's overall E&E exports will remain supported in the second half of this year. The question really now is for domestic demand, and there have been some rumblings on the domestic front, particularly when it comes to regional politics. We will see the Johor state elections on the 11th of July, as well as Negeri Sembilan state election on the 1st of August. There have been reports that these two elections will gear up the overall administration for general elections, which are due to be called only before early 2028. That said, policy that has been put in place by the Madani government has yielded strong results in terms of solid public infrastructure spending, private sector investment spending, and overall strength in household consumption. We do expect that domestic demand will remain resilient, albeit while moderating slightly in the second half of 2026 and 2027. When we look at the policy mix, we don't see any reason for Bank Negara Malaysia to adjust monetary policy settings in the near future. Therefore, we do expect BNM to keep its policy rate unchanged through the second half of 2026. However, as we go into 2027, the case for normalizing the policy rate from 2.75 to 3% becomes a little bit more convincing in our view. And we do think that Bank Negara will pull that trigger in early 2027. The biggest risk for the Malaysian economy has actually been on the fiscal side, and we have highlighted before that we are expecting fiscal slippage of about 0.1% of GDP as early as March of 2026. However, in recent months, the fuel subsidy bill for RON 95 as well as diesel has increased substantially, which has led the government to tweak its budi diesel mechanism. And although the overall mechanism is projected to yield 0.1% of GDP in savings, we do think that there is significant fiscal slippage when it comes to the overall fuel subsidy bill for 2026. This slippage is to the magnitude of closer to 1% of GDP, part of which can be offset by Petronas dividends, which we project will be increased to about 32 billion ringgit this year, compared to a budget estimate of 20 billion ringgit. That said, we do not believe that Petronas dividends can completely offset the fiscal slippage. Therefore, we now expect the fiscal deficit to be around 0.2% of GDP, wider than the budget. We don't expect that this will trigger a very violent reaction across sentiment for Malaysian assets. However, we do believe that as fuel subsidies remain in place, it will still cause stress on the subsidy bill.